Welcome to my accounting classroom. I'm Sid Bundy. Today, I'm going to animate a quick sketch of the break-even point and then walk through an example for calculating break-even point in total sales dollars. When a company's net income is zero, we say that they've broken even. In cost volume profit analysis, the break-even point occurs when total revenues equal total costs. Let's look at a CVP graph where the y-axis is in dollars of cost or revenue and the x-axis represents units. In econ, this is denoted as P for price and Q for quantity. We can visualize the break-even point as the intersection of two straight lines. Fixed costs within the relevant range are unchanged by quantity, so they are denoted by a horizontal line. Accountants depict variable costs as a straight line where the slope is the marginal cost per unit. Since total cost equals the fixed cost plus variable cost, the total cost line runs parallel to the vertical cost line with the y-intercept equal to the fixed cost. Revenue is the price times the quantity. Normally the price is larger than the contribution margin. That is, the price is higher than the slope of the line for total cost. So even though the revenue starts at zero, where zero sales means zero revenue, the line should rise more quickly and eventually overtake the total cost line. At quantities where total cost is greater than revenue, the company is operating at a loss. At quantities where total cost is less than revenue, the company is operating at a profit. The magic point where the two lines meet is called break even. By setting the two formulas for lines equal, we can use simple algebra to answer all sorts of management questions. Let's work through a quick example. This year, a company earns $1,800 of total revenue. Fixed costs are $400 and the contribution margin is 25%. Calculate current net income or loss and the break-even point in total sales dollars. Look back at the formulas for a moment. We know that revenues minus expenses equals net income, and with CVP analysis, we can restate the expense formula as 1 minus the contribution margin times the variable cost plus fixed costs. If we set the revenue equal to expenses, we can solve for R to find the break-even point in total revenue or sales dollars. If we plug our example into the first formula and solve for net income, we find that the company didn't cover their costs, and they actually lost $1,000. Plugging the example information into the formula for break-even and solving for R shows us that the company has to have $2,400 in sales in order to break even. If you found this video helpful or would like to suggest a topic for my next video, don't forget to leave a comment.